Hello everybody, my name is Lush Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record a video per week, so make sure you ring the notification bell to get notified each time one comes out. You should have certain things done by the time you are 60, since retirement for most people is right around the corner. You still have a few years to make some tweaks, but retirement is coming and soon. So these are the 6 things you should have handled by 60. Number 1, know your retirement number. This is the size of your portfolio that you need to retire and do what you want to do in retirement. What should your number look like? It can be the result of a financial plan with the inputs of your current portfolio when you want to retire and your expected income in retirement. The output of this plan will be whether you're already there and can retire now, whether you're on track and will have enough to meet your goals, or that you are behind and either need to save more, work longer, get riskier but higher return investments, work part-time during retirement, etc., etc. The number could also be done using a 4% rule of thumb, where you need assets of 25 times how much you want to spend in retirement per year, and those assets should last you 30 plus years. The input is just your expected income in retirement. Number 2, know your asset allocation. Asset allocation is simply where your money is invested. Is it in cash, bonds, big dividend payers, or smaller, growthier companies? Look at your current allocation. Is it already ready for retirement in a 3-bucket portfolio using the bucket strategy? Or are you still running a 60-40 portfolio with 60% in the more volatile stocks and 40% in bonds for safety? If it is the 60-40, or maybe even in an all-stock portfolio, you should look at making small changes tax efficiently over the next 5 years to transition your portfolio into the 3 buckets of 2 years worth of expenses in cash to counter market downturns, a second bucket of 8 years of spending in big, safe, dividend paying companies and bonds, and the third bucket for growth to outpace inflation, containing whatever else you have left. The bucket portfolio is good at withstanding pullbacks because you can live off the cash in bucket 1 during a downturn in the markets for up to 2 years, not having to pull money out of stocks that have come down. Look at your portfolio or have your financial advisor look at it and figure out whether you're in a good place for retirement or whether changes need to be made. Item number 3, tax planning. Sorry, it needs to happen, whether formally or informally, just thinking about it. Determine what accounts your assets are in, from best to worst for taxes, TFSA and FHSA if used for a home purchase, with no tax impact at all, non-registered accounts with taxes only being paid on the gains, to RRSPs where everything that comes out of it is taxed harshly. If you have big ticket items with lots of capital gains like investment properties, look at the timing of selling those and not selling anything else during that year. Think about taxes over time, including trigger dates like 60 years old, 65, 70, and 71. The first 3 is for starting to take CPP and OAS, and the last one for when you are forced to take RSPs out. Try to keep your tax brackets constant and as low as possible, but avoid years with lots of taxable income and then years with very low income, since the taxes are high on that scenario. That is, 2 years of 50,000 income are much better than 1 year 100,000 income and then 1 year with 0 income, to use an extreme. So you may consider taking RSPs out starting at 60 if you have over $500,000 in RSPs, for example, to smooth out your taxes. Item number 4, planning out your insurance. First, we can look at retirement healthcare costs. In Canada, we have most of healthcare covered, but an assisted living home, depending on whether you want a pool or not, can still be costly later in life. So look at long-term care insurance or saving extra for it. Insurance companies may make you meet certain metrics before they will pay out, so you may want to just self-insure. Now, you can consider using the value of your home to cover this large expense at the uh, near the end of life, especially since you won't need the house anymore. Secondly, look at life insurance. You shouldn't have any financial dependence at this point at 60 years old, but you may want to have a small term life policy that will bypass probate and be available to pay for your funeral. Or just give your most responsible child or friend 30,000 cash earmarked for that occasion. Number 5, think through your actual retirement goals. What do you want to have done by 60? Do you want to have the mortgage paid off before you retire? Are you still helping kids with college? If so, build that into the plan. Remember that there's the go-go years, slow-go years, and no-go years in retirement. As you are busy and spending money while you still can do the things like travel at the start of retirement, when you have lots of time all of a sudden, you get that out of your system and then enter the slow-go years, just visiting the grandkids once in a while, and finally the no-go years, when you stick around the house until you possibly go into the aforementioned long-term care. Also, plan for a new roof and a car every 10 or 20 years. And finally, item number 6, government pensions. Look at old age security and the Canadian pension plan and determine when to start taking them. CPP you can take as early as 60, old age security at 65, and both can be taken as late as 70. Figure out when you want to take them and how much you will be getting. The later you take them, the more money you'll receive each month, but then you'll get less payments. Some rules of thumb are: try to take them later in general, especially if your relatives are long-lived. Take them early if you need the money and can't bridge the gap between the end of work and 70. If you have a lot of RRSPs, which you'll be forced to take at 71 and it'll put you in a high tax bracket, consider taking old age security at 65 so you get OAS for at least the 6 years, because at 71 it might be getting clawed back. And a little bit of planning and talking to Services Canada about your pension and or your financial planner will help you know what you need to do by 60. So those are the 6 things you should have covered, decided on, or at least thought about by the time you turn 60. If you have any requests on what you'd like me to cover in future videos, please put that in the comment section. If you'd like to get in touch, please reach out on any of these social media channels, and may you have a profitable day.